Hello, I'm Dick.
And I'm Eric, and we're the Annuity guys.
Eric, you've been talking a lot, we have been talking a lot about these uncapped indexes or indices. And what's really driving these are some of these new volatility indexes.
Yeah.
And there's probably a more correct word for that.
Indexes. Well, and what I like about these is it's the true uncapped nature. Because one of the biggest problems we have with especially indexed annuities is talking about caps and participation rates. And before you start to get into all the details, most people's eyes glaze over and they go, what the heck? You know, the cap's going to do this and it stops you from making... Well, these newer style, lower volatility indexes, what's nice is they're uncapped. It's a true, you put it in, and usually this is what you're going to get. This is what's going to be credited to your account.
A little bit easier to understand.
Yeah.
But what I like also, and we've talked about this on other videos, is that this allows the client the potential for more interest. And it would seem that you know, anytime that you can do a win-win where it doesn't hurt the company,
right,
and they can create a higher interest payout to their clients. That's a good thing.
I think it's a wonderful thing, you know. And we've talked a lot in some past videos about how they use options to kind of create this growth and share the potential, share the earnings basically with the client.
Yes.
Well, what they've done with these volatility measured indexes is they've been able to help measure volatility somewhat, and so because when times of high volatility, the cost of options is increased. So by being able to help participate when things are a little bit more realistic, it makes it for a more profitable experience for both the client and the company.
Yes, and if I could maybe just take a moment and you can embellish on it a little bit, but
embellish.
talk about these volatility indexes in the sense of what they are. Because you correct me, but my understanding as we get deeper into these is it's really a page taken out of the tactically managed funds.
Really, it is.
Mutual funds and just different types of managed money accounts where folks that do this for a living analyze the market and go, hey, stocks are not in favor right now. It's kind of obvious. So why should we have all of our money sitting over there? Let's move it over to cash, or let's move it over to bonds. And it's the same way with buying options. There's times when things are out of favor.
Right.
And so why would it make sense to just keep buying the options towards something that's not in favor?
Right.
Is that correct?
I think that's a big part of it. It's, you look at it, and these are mathematical formulas. There's not, they're taking the human emotional side, I think, out of the equation.
And I do like that.
And so what you have is, based off of certain triggers in these formulas, they move in and out of basically what they think is going to be a higher performing piece, either like a cash or a cash equivalent or a bond, versus being an index in the market. So by moving in and out of those two positions and balancing that based off of volatility or other indicators, it creates a more profitable experience. And it's just very similar to the tactically managed accounts that you referred to. So
now, one of the things that we've discovered, Eric, is that these are not all created equal. Everybody's starting to come out with them.
Yes.
And some of them have a tendency to maybe perform better than others, but some of them, their numbers are more hypothetical and not based on real historicals.
Right. And it's nice to create a mathematical model and then say, well, let's just figure out how to make something that looks good, and we'll run the numbers backwards and say, yeah, see, if you would have done this 100 years ago, see how it would have performed. Well, it didn't really exist in that time frame.
Exactly.
So the historicals are based off of basically if you went back and reran the math. Some people do it thousands of times when they run these scenarios. Others look at once a month, and some are just kind of make believe scenarios that not so much based off of the fact, but.
So it would be wise. We enlighten our clients or prospective clients about the differences. But it would be wise for folks to ask these questions. Is this based on real historical numbers? Even though it's a managed index and there's some hypothetical aspect to it, there's ways to gauge where it may or may not be more successful.
Right, and
accurately.
Part of it's looking back at those historical numbers and seeing where it performed well and how it did during certain time frames. And comparing that to where you expect we're going in the next few years and how these could potentially perform as well.
And everybody knows that past performance never predicts
Yes,
future performance.
That's exactly right.
The number one thing that all investment advisors and all disclosures say, and it would go here too, that no one can really predict the future.
No, but what we've seen with these indices is typically you're not getting the highs, the super highs of the market, or the super lows. Now, with any index, nice thing is you're good. Zero's the worst you're going to do, as far as the index crediting.
Right.
But what we've seen in most of these numbers is you see a more stable performance of consistently getting something. So it's what I've seen is I've been very impressed with the way they've generated the models and what I've seen and the potential it gives to the clients as far as income now and in the future.
Right. And we've kind of jumped into this without really defining that we're really talking about the hybrid annuity.
Yes.
The fixed indexed annuity. And they have always, for the last 20 years, had different indexes.
Yeah.
S&P, very popular, Dow.
NASDAQ.
Right. And these new volatility indexes will involve the Barclays Bond Fund.
I've seen bonds. I've seen S&P.
Yes.
I've seen some names that I haven't been familiar with.
Yes.
But if you look at what the underlying elements that build the index, most of those are pretty well known and you'll recognize.
Right. So if we were to summarize this, how would you summarize? How does this work out for the insurance company? How does it work out for the client?
Well, I think that in summary, Dick, it really works out better for both, is what we're finding. It's a win-win.